Dear traders, coming to Asia market, yen bears just tried to push this market through a 2-year ceiling, and they got violently rejected. Right now US dollar to Japanese yen is trading at 156.67, but the real story is the structure left behind, an exhaustion wick on the daily chart, a 4H trend turning firmly bearish, and a dangerous vacuum between here and 155.66. There is one trapdoor and one hidden opportunity today. I'll show you both. Stay until the end because I'm giving out 3 exact entry and exit levels you can execute immediately. I am Eric from Alpha Market Meridian, Instant Market Verdict. The session bias is bearish, but we are fading into a support cluster, so we treat this as a controlled bear trend, not a chase. The one invalidation level that proves this bias completely wrong is a 4H candle close above 157.56. Write that number down. 157.56. If buyers recapture that zone, the breakdown narrative dies and we flip to range-bound between 157.50 and 158.50. Until then, the weight is lower. Let's walk the chart top-down because most traders are looking at the wrong time frame. On the weekly, US dollar to Japanese yen just printed a massive shooting star rejection from the 158.00 handle. That's the 2-year high zone everyone was watching. The weekly MA20, currently flattening near 156.90, has now been lost. Price sliced through it and is trying to accelerate away. The psychology here is critical. When a multi-year resistance holds and the market breaks back below the mean reversion level, it signals that momentum has flipped from buying the dip to selling the rip. The daily chart confirms this gravity. We are in a clear bearish sequence, with Monday's session closing well below the daily MA60 near 157.15. The MA60 is now curling down and acting as dynamic resistance. The daily MACD has crossed bearish, and more importantly, the histogram bars are expanding below the zero line. That tells us momentum is not just pausing, it is accelerating to the downside. The daily support zone sits at 156.26, which is the overnight low we already tested once. Below that, the magnet is 155.66, a structural level that aligns with the daily MA200. And the 200-day moving average is the line in the sand that separates the bull market structure from a genuine collapse. If we slice through 155.66 on a daily closing basis, the long-term trend flips, and we could see a rapid unwind toward 154.00. That's where the big funds reprice their carry trades, now descend to the 4H chart. The 4H trend is bearish with a series of lower highs and lower lows. The 4H MA20 at 156.98 has crossed below the MA60 at 157.22. This death cross on the 4H is fresh, which means any pullback towards that 157.00 to 157.20 region will be met with algorithmic selling. The MACD on 4H is deeply negative, but here's the nuance that separates amateurs from professionals. We are seeing a slight loss of downside momentum on the 60-minute chart. The 60M MACD is trying to put in a bullish convergence, which warns me that a short squeeze bounce is possible before the next leg lower. So chasing breakdowns below 156.26 is dangerous. That is exactly why we wait for the retest. Support on the 60M is current price zone around 156.66, but the real floor is the Asian session low at 156.26. Resistance sits at 157.21, the top of the 4H consolidation box, and above that 157.56, the start of the bearish imbalance. If you see price rip into 157.21 and stall, that's your opportunity. If it blasts through 157.56, stop thinking short. The structure has changed. Before we get to the fundamental driver, let's bring in the ghost that's haunting this chart. It's the Nikkei whisper. As part of our daily cross-asset confirmation, we watch the Nikkei 225 because US dollar to Japanese yen and Japanese equities share a risk heartbeat. Right now, the Nikkei is failing to hold its early gains and has slipped back below its own key pivot. That is classic risk-off yen repatriation. When Nikkei futures sell off and US dollar to Japanese yen drop simultaneously, it's not a coincidence. It's Japanese investors pulling capital home, and that flow intensifies during the Tokyo fix. This mutual validation tells us the move is genuine, not just a dollar weakness story. If you see the Nikkei suddenly bounce and hold above its opening level while US dollar to Japanese yen refuses to make new lows, that would be a divergence warning of a liquidity trap. Pay attention to that correlation. It's the edge nobody talks about. Here's the fundamental driver. The headline today is that yen bears are pulling back from that 2-year high, and the catalyst isn't actual intervention. It's the fear of intervention and a sharp repricing of the Bank of Japan's summer policy. Overnight, Japanese real yields tick higher on growing conviction that the BOJ will deliver a rate hike and further taper its bond purchases in the July meeting. This narrows the yield differential between US Treasuries and JGBs just enough to squeeze the carry trade. The US 10-year yield has stalled at its own resistance, failing to push higher. That's a double weight on US dollar to Japanese yen. Furthermore, the verbal warnings from the Ministry of Finance have escalated. A senior official was quoted saying they are watching speculative moves with a high sense of urgency. The market is now in the intervention ghost zone, which means traders are front-running each other's exits. This makes the downside slippery. My 1 to 2 week lean is that US dollar to Japanese yen grinds toward 155.00, absorbing the correction, unless we see US yield spike suddenly on a hot data surprise. The exact event that would kill this bearish lean is a daily close above 157.56, or a BOJ decision that disappoints the tightening expectations. Until then, fade rips. Most people will skip this, but this is where money is made. Keep watching. Strategy 1. The sniper. Conservative. We wait for the daily support to break cleanly. The trigger is a 4H candle close below 156.26 with follow-through on the next 15-minute candle. Entry is short at the retest of 156.26. Your stop loss goes at 156.68, just above the current intraday congestion and the 60 MA20. That's a risk of roughly 42 pips. Target 1 is 155.70, right above the 155.66 magnet, giving you a 1-to-1 and a third risk reward. Move your stop to break even once target 1 is hit. Target 2 is 155.00, a psychological round number and structural support, taking your risk reward to 1 to 3. This setup is voided if price rallies back above 157.00 before the breakdown occurs. We don't chase the break, we wait for the retest confirmation. Patience is the edge. Strategy 2, the active trader, standard. This plays the mean reversion fade inside the bear trend. Entry is a limit sell at the 4H resistance cluster of 157.18. I want to see a clear rejection wick or a bearish engulfing candle on the 30-minute chart at that level before entry. If price just spikes and rips through, stand aside. Stop loss is at 157.58, above the structural invalidation and the 4H MA60. That's 40 pips of risk. Target 1 is 156.50, capturing the move back into the intraday value area. Once target 1 is hit, trail the stop to entry minus a 5 pip buffer. Target 2 is 156.00, the lower edge of the range, delivering a 1 to 2.5 risk reward. This setup works beautifully in a slow grind lower, but you must respect the Tokyo opening liquidity spike. If we are still holding the position into tomorrow's Asia Open, tighten stops to just above the overnight high. Let's see how aligned we are. Type your USD JPY range for tomorrow in the comments now. I am reading every single one to gauge crowd positioning. Strategy 3, the aggressor, high risk. This is a counter-trend scalp on the bounce chance I mentioned. The 60 MACD divergence suggests a potential pop toward resistance. Entry is a market buy right here at 156.67, but only if we hold above 156.50 without breaking. Your stop loss is extremely tight at 156.20, just below the Asian low. Risk is 47 pips. Target 1 is 157.05. The 15-minute breaker block and a quick 1-to-1 scalp. Target 2 is 157.18. The full retracement into resistance. This trade relies on a sudden yen weakening spike, possibly a position adjustment before the fix. If the 15-minute candle prints a solid bearish Marubozu below 156.50, scratch the idea instantly. This is only for those who know how to lose small and manage risk aggressively. Do not scale into this unless you are comfortable losing the allocated amount in minutes. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news. Stops are non-negotiable. Liquidity gaps in US dollar to Japanese yen are real, especially around the Tokyo fix, so you must factor in slippage by using the correct position size. Let's wrap this up with the one most critical number. Tomorrow's session hinges entirely on 155.66. If that daily MA200 and structural support gives way, we are entering a new leg lower that could redefine the carry trade for the quarter. If it holds and we bounce, we will chop sideways and digest. I'll be back tomorrow with the detailed game plan, specifically watching the Bank of Japan's routine bond operation and any further verbal intervention. The Nikkei reaction will once again be our truth serum. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen. Smash the like button if this analysis gave you a clear, executable plan. Subscribe and hit the bell for daily coverage across 8 key assets. I'll see you in the next one.